All right, welcome to The Explainer. Today we're going to break down a topic that, let's be honest, most of us pay for every single month, but we really hope we never have to use insurance. Yeah, it can feel like this maze of confusing policies and tiny fine print, but don't worry, we're going to make it simple and show you what actually matters.
Okay, so what is insurance, really, at its heart? Look, it's not some magic shield that stops bad things from happening. Think of it more like a financial shock absorber. It's a system designed to make sure that one piece of really bad luck, a car crash, a storm, a house fire, doesn't completely destroy you financially.
So, how does this whole protection thing actually work? What's the big idea, the mechanism that turns a personal disaster into something manageable?
Well, it's basically a simple trade. You pay a company a pretty small, predictable amount of money every month or year, and in return for that payment, they agree to take on your huge, scary, unpredictable financial risk. So a devastating loss for you becomes just another calculated, payable expense for them.
Now, you might be wondering, how on earth can a company afford to take on that kind of massive risk? Well, it all comes down to this one core idea: risk pooling. This is the engine that makes the whole system go. See, the company collects those smaller payments, those premiums, from thousands and thousands of people, and they put it all into one giant pot of money. They know, statistically, that only a few people are going to need a big payout at any given time, so that huge shared pot is more than enough to cover those who do.
Okay, if you're going to get a handle on your own insurance, you've got to speak the language. So let's quickly build up our vocabulary with some of the essential terms you're going to see in pretty much any policy.
First up, the policyholder. Simple enough, right? That's you, or your family, or your business. It's whoever's buying the protection.
And you're buying that protection from the insurer. That's the insurance company. They're the ones taking on your risk. They are the financial shock absorber in this whole deal.
And the price you pay for that service? That's the premium. It's that fixed, regular payment, monthly, yearly, whatever, that keeps your policy active. You stop paying it, and poof, your safety net vanishes.
And all of this is laid out in the policy. And listen, this is the most important document. It's the legal contract that spells out everything: what's covered, what's not, and all the rules for both you and the insurer.
All right, now that we've got the lingo down, let's talk about the money mechanics. This is where you really see the crucial trade-offs you have to make when you're picking out a plan.
And this right here, this is the central trade-off you'll find in almost every single policy. It's a balancing act between your premium and your deductible. It's pretty simple, really. If you want to pay a lower bill every month, you have to agree to pay more out of your own pocket when something actually goes wrong. If you want the insurance company to cover more of the cost, well, you're going to have to pay them a higher premium.
Okay, so let's see how this plays out in the real world. Just look at the example here. You get into a car accident, and the total repair bill comes to $2,000. If your policy has a $500 deductible, that means you pay the first $500 out of your own pocket. Only then does the insurer step in to pay the rest, that remaining $1,500. The deductible is basically your share of the risk before their help kicks in.
All right, so filing a claim sounds easy enough, right? But it's not always that straightforward. It can actually trigger consequences you might not even see coming, even when you're not the one to blame.
So, let's play out a super common scenario. You're just sitting at a red light, minding your own business, and bam, someone rear-ends you. It's clearly 100% their fault. So when you file that claim, it's not going to affect your rates or anything, right?
You'd think the answer would be a clear no, but it's just not that simple. Even when you are completely innocent, the simple act of filing a claim goes on your record. And that record, well, it can absolutely be used to decide how risky you are in the future. And the reason why is something called a CLUE report. Now think of this thing like a credit report, but specifically for your insurance history. It logs all of your auto and property claims for up to 7 years, and that includes claims where you weren't at fault and even little things like calls for roadside assistance. To an insurer, a long list of claims can be a red flag signaling a higher risk, and you guessed it, that can mean higher premiums for you down the road. And you know what? It's not just about car accidents. Insurers are constantly looking for other kinds of risks. This quote here from our source material is a perfect example. Someone had their homeowner's insurance canceled just because they owned a specific breed of dog, like a pit bull or a Rottweiler, that the insurance company decided was just too much of a liability risk. So all of this, it really brings us to what might be the most important point of all. You absolutely have to know what's buried in the fine print of your policy. I mean, check out this story from our source material. It's a tough one.
This landlord had several rental properties. Some thieves came in and stripped all the copper out of the AC units, a massive, massive expense. He was sure he was covered, but when he filed the claim, he found out that his policy specifically excluded theft. He had to eat the entire cost. He was on the hook for every single penny.
And that story really leads to the key question you have to ask yourself. We all get so focused on that monthly premium, that number, that we don't even check for the gotchas. Are you actually covered for theft? What about if you need a rental car after an accident? Or what about certain kinds of water damage? Just assuming you're covered is honestly one of the most expensive mistakes you can ever make.
So look, here's the bottom line. The single most powerful, most important thing you can do is to stop assuming and start reading. Seriously, go pull out your policy documents, look at the declarations page, and find out exactly what you are and are not paying for. Don't wait until it's too late to find out.
So, we'll leave you at this. Being insured isn't just about paying a bill. It's about really understanding the promises and the limits of your own financial safety net. So after watching this, what is the one thing, the one exclusion or coverage gap that you're going to check in your own policy? Finding out now, before you need it, that could make all the difference.